Happy Friday, traders. It is 8:01 a.m. Chicago time on Friday, September 11th, 9/11, 2015. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. A quick reminder that this is the 14th anniversary of the 9/11, September 11th attack on the World Trade Center. So there are going to be periods of time when the floor, the trading floors, are what's left of them, are going to exercise or observe a moment of silence in trading today. I don't think that's going to affect us much at all, but it is out there. Let's take a quick look at what the overnight news brought to us. Goldman Sachs analyst cuts oil price forecast, citing global surplus, potential for WTI to fall near $20 per barrel. You know how these analyst predictions are. They're not something you want to trade on. Strong moves in the euro, Swiss franc this morning. It is the highest it has been since the Swiss National Bank removed the floor last year. And in August, PPI final demand comes in at 0 versus negative 0.1%, and then comes in at year over year at negative 0.8 versus negative 0.9. Looking ahead, we have University of Michigan at 9 o'clock Central. It's a half hour after the open. Expecting 91.1. This is the preliminary number. It could be a mover. You want to pay attention to it. 91.1 expected at 9 o'clock Central, 10 Eastern. Excuse me. And then at noon, we have a Baker Hughes rig count. I'm not sure if that's, I don't believe that it has much of an effect anymore. And then 1 o'clock Central, 2 Eastern, we have the monthly budget statement, expecting negative 81 billion. It looks like the docket's pretty clear on speakers. Let's move to the technical picture. I'm going to start today with a view on the cash chart, the fundamentals chart. This is the SPX. You can see the move that took place at the end of August, the pullback to about 50%. And then an attempt lower. What it ended up doing is creating a triangle, and we broke out of that triangle a couple days ago with a gap up, which fell right back into the triangle. And then yesterday it opened at the low end of the gap, the low end of the sell-off day, and has basically traded inside on the SPX. The thing to observe here is the fact that 52-week lows are starting to turn up again. 52-week highs starting to turn down again. The put-call ratio rising, so there's some insurance being bought here, expectation of lower prices. I'm not sure what that means. I'm going to pay close attention to how today's action is going to be, but even though I'm a day trader and I'm not interested in the long time horizon for my trades, this is a level of context that is very important. So this is something I'm watching. The 5 key sectors of the S&P pretty stable yesterday, just holding sideways. But the fact that this 52-week low turning up may lead us to further, maybe an indication of further selling to come. I'm not sure. I did expect this action to continue higher. The sell-off that we had on Wednesday was very interesting. I expected it to pull back into the prior day's range and then to continue higher and to trade this quick drop, which was not auctioned properly. We have a lot of structural defect here, or structural weakness on the sell-off, because it was a panicked sell-off. So that was what was expected. Maybe it is brewing to be that. We're going to continue to balance in the zone in the SPX before we break higher. A reminder again that I'm quoting December contracts on the U.S. equities. In fact, the only thing that remains in September is the European equities, which expire next Friday. They trade up to expiration. They trade the current month till expiration. They don't roll early. So right now, I'm looking at December, looking at yesterday's action versus what we expected. Yesterday's primary hypothesis. This is kind of noisy because I have a 4-tick Renko up. I won't change it because it causes a delay. But overall, yesterday's expected action was a push up into this 34 area or so, a test, and then I expected it to roll over and start to extend this low. Remember, the prior day ended up being a multi-distribution profile, and it was the auction seemed incomplete, looked incomplete to me on the downside. So I was expecting a lower low. I was expecting the market to pull back and then to walk its way down to this 1912 quarter. That did not happen. Hypo 2 was for a choppy open, an attempt lower, and then a push through the this 34 area, and then to target the 48, and then the 60.75. So yesterday, if you're hearing my cat in the background, I don't know why he's complaining. So yesterday, Hypo 1 did not work for a short bit of time. Hypo 2 took over. The primary indication of Hypo 2 taking over is this impulsive move, 6 points, 6 points above the opening swing, and then its inability to maintain below the mid. And so that set us up for a continuation move. It took forever. This was a lot of noise here. But the continuation move to take out 46 and get to this HVN took a while, but it ultimately got it right here. Didn't quite push to 1960.75 before it found sellers. Sellers came in with a really nice taper. You could see that the profile tapered very nicely. This is a fairly decent high, and then we pushed back down into the mid. Point of control, VWAP, it was all mushed up right in here. So we end up with a sharp value area and a sharp point of control yesterday. So the market closed in balance yesterday. So overall, when we look at the big picture, what we end up having to do is we end up having to draw this composite. So this is a new micro composite here that includes these 3 days. Why? This day opened in gap. We still have a gap zone beneath us that we left open. Here's the gap zone. This is the gap zone high, 2150. Yesterday it stopped at 25. Leaves us with a 3.5 point gap zone. 2250 is the non-farm payrolls scene of the crime, or where the move for non-farm payrolls occurred. But overall, this has gapped up and pushed up. We have gapped up on Wednesday and pushed down. And then yesterday we opened in range out of value and we pushed back up. And so with the back and forth within the same price range, we have a composite zone or a balance zone. And so we could see clearly here that the point of control for this area is at 40 quarter. That's this price here, this black line, 40 quarter, which is exactly where we closed yesterday. Heavy trading in this zone. The next area up is right here, which also represents the value high at 60.75. So any push up will likely target that 60.75, which happens to be this point of control, this naked point of control anyway. So 60.75 represents value high and naked point of control. in this micro composite balance zone. It's also a composite high volume node over a long period of time as well. So this is going to this is likely to be the next resistance area going up. Coming down, we're looking at the 1912 quarter area. There is a small LVN here, MCLVN, but I'm not too concerned about it. I think we're likely to fill the gap over the next couple of days. I think the formation that's being created here looks something like this. This is where we're likely to end up. It's just not able to maintain. The sellers are still in control from that sell-off. We still have an incomplete impulsive move from August the 21st through the 24th. And, I know the low for that period was 1831 on the September contract, which is now, 1822 or something. And it's a long way down. But it does present itself as a long-term play on the short side because that move was incomplete. Unfortunately, when we play those moves on a swing basis, we're playing against the central banks and so forth, like I said yesterday. So today we're opening. Let's take a quick glance at the overnight session. The overnight session was really inactive. Look at this profile. It's got one distribution, small distribution up top, and then it has this massive kurtosis below. Kind of a funny looking profile. The market did try to push higher and balance for a little bit before it dropped on the European Open and has been trading the lower range. This looks heavy to me. The low is pretty weak on this. I'm expecting this to spill over and take out this 1919 and start moving towards that 1912 area. So that's my primary hypothesis. The big wild card here is the Michigan sentiment. I'm not sure how much control that'll have, but overall, I'm looking for the primary hypothesis to be responsive buying into this 1940 quarter point of control, and then I'm looking for it to rotate down and start making its way to 1912 and a quarter. That means today's hypo 1 is the same as yesterday's hypo 1. I might be proven wrong here, but this has tried to go higher, and sellers just step in and put an end to it and push it down. The rotations down have been pretty substantial compared to the rotations up. And so I expect this to resolve itself on the downside. The other reason I expect it to resolve itself on the downside is because of the gap structure below. We have this small kind of day on its own out here that has not been tested yet. So I expect this to be the play for today. I expect it to move lower. With that being said, knowing that my stronger bias or higher probability bias is on the short side, my job now as a trader is to find areas that give me an advantage to get short with a target that is at least a one multiple of risk at a minimum. And then it just makes my job easier as opposed to being open to whichever way the market opens. Goes. That does not mean I don't pay attention to the action. Now, if my primary hypo is to go down and the market tests below like it did yesterday, tests the prior day's low, and then it finds buyers and starts moving up, that gives me a much easier opportunity to get to reverse. You've got to be flexible. Again, it's that Monty Hall thing. Anyway, I might be confusing you with all that information, but in any case, this morning, looking for responsive buying to 40, to a limit of 40. It could turn anytime ahead of that or around that area. Remember, this is a point of control here, and then I'm expecting it to roll down into the 1912. Okay, that's all I have for you for today. Remember, there's an interview out with Chat with Traders that's on the Twitter feed. I've been retweeting it. I suggest you listen to it if you're following these Trader Bites. It gives you a little bit of background and basically the context from which I trade. It was a job very well done by Aaron of Chat with Traders, and you might find it interesting. It's about an hour and 39 minutes. It's a podcast, so it's something you can take with you on your smartphone or while you're driving. Good luck today. It's Friday. Watch your risk as always, but especially today, since we don't want to go into the weekend with a hole in our pocket. It kind of destroys the mood for the weekend. So just pick your spots. It's probably better to wait for the Michigan sentiment number to come out before initiating a first trade. It also gives you a half hour to assess who's in control, which time frame is in control, and which direction is in control before staking your hard-earned cash in the market. Good luck today, and I'll catch you later. Take care.